Since 1972, the McIlvaney Financial Group has been a conservative, contrarian investment firm. With that mindset, they have created a multifaceted approach to portfolio management, offering a wide array of services including hedging through precious metals, wealth advising, a unique short fund, and an excellent educational resources. We have had David McIlvaney on our show multiple times because we respect his outlook, viewpoints, and recommendations. You really need to take advantage of the free portfolio risk analysis and bank safety ratings they're offering our listeners. Just call them at 1-800-525-9556, and you will be put in touch with an advisor with years of experience who can take 15 minutes and give you a much better understanding of what true portfolio diversification is. Again, call them at 1-800-525-9556 and benefit from their expertise. Hi everyone, this is Jason Bjork of Wall Street for Main Street. Welcome back to another Wall Street for Main Street podcast interview. Today's special guest is one of my favorite guests. He's a returning guest. He's editor and publisher of the Gloom, Boom, and Doom Report. Dr. Marc Faber, thank you for joining me again.
My pleasure, thank you.
Now, Mark, the Federal Reserve has already increased interest rates in March. Do you expect to see more interest rate increases coming in 2017?
Well, I think it's possible that they increase it one more time, but I doubt they'll go far beyond that. In other words, some Fed members have opined that they would increase rates 3 times this year. That I doubt for the simple reason that the economic statistics that are rather looking forward than backwards are rather negative. In other words, the economy is not doing particularly well, and you can see it from the GDP figures. Employment is strong, but it's mostly lower quality jobs that are increasing and not higher quality jobs. So overall, I'd say it's a very mixed picture. And I actually happen to believe that after having been more than 8 years into a bull market for equities and asset prices, essentially since early 2009, the markets are expensive, and B, the economy this June will be 8 years into an expansion, which is far more longer than traditional expansions have lasted. So I think we're at the tail end of a colossal asset inflation and also of an economic expansion. I don't think that we should expect the economy to strengthen.
Yeah, I don't think the real economy has matched what the asset prices has done. The FOMC members in the minutes released yesterday have basically admitted the stock market is a bubble, along with many other asset classes. And the Federal Reserve, Janet Yellen, has talked about now meaningfully reducing the balance sheet. Do you think they're going to try to meaningfully reduce the balance sheet in the near future?
That I very much doubt. On the contrary, I think that by the fall, the economy could be so weak that they will talk about QE4 and maybe even implement QE4. That would be my sense.
That would be interesting because there's a lot of Democrats, hardcore Democrats at the Federal Reserve. Janet Yellen's a lifelong Democrat. Many of them hate Trump. I interviewed Danielle DiMartino Booth, who wrote the book Fed Up, and she thinks that the Federal Reserve has become very politicized and they want to use the interest rate increases as a weapon to hurt Trump and to hurt the Republicans in the 2018 congressional elections.
That is a possibility, but I'm not sure that this is a factual assumption. We'll have to see. I think the Fed and also other central banks realize that if they don't increase rates now, they miss the opportunity to lower them again in future, you understand?
Yes.
So I think they probably prefer to raise them somewhat, and the Fed is basically behind the curve. In other words, the Fed fund rate based on today's rate of inflation and also based on bond yields should be more like 1.5% to 2% than below 1%.
Mark, do you think that this is one of the most overvalued U.S. stock markets in history, comparable to valuations in 1929, 1999, and 2007?
Well, I wasn't alive in 29, but the valuations actually for the entire stock market was lower in 29 than it is now. Usually stock markets have different components and different sectors. And so in year 73, the most overvalued sector were the Nifty 50. These were institutional favorite stocks. Among them, by the way, also Polaroid and Xerox and Eastman Kodak, Sears, J.C. Penney, and so forth. These were, at the time, the growth stocks. And then the market collapsed. But other stocks in 73 were not terribly overvalued. And then in 81, oil stocks were overvalued and oil drillers and so forth, and then they collapsed. And in 99, it was the technology sector, media, and telecommunication. So it's always selected. I'd say today, the unusual feature of asset markets is that everything is inflated. Whether you look at real estate, equities, bonds, everything is expensive, including also collectibles and cars and art and so forth. So we are in a colossal debt bubble. Whether we are in a colossal stock bubble depends on the sector. Some stocks are grossly overvalued, in my opinion, and others are not terribly expensive. Equally, there are some markets in the world that are not terribly expensive relative to the U.S. The U.S. is probably the most expensive market on average.
The small caps, Mark, the Russell 2000, they're starting to break down. But, it seems because of the global central banks, all these central banks, whether it's the Bank of Japan, the European Central Bank, or the Federal Reserve, with their financial repression and manipulating interest rates lower, there's been an enormous chase for yield. So a lot of these large cap dividend stocks, these things on their earnings ratios, their PEs, they're trading like growth stocks now.
Yes, to some extent, yes. But it's difficult to make a definite statement simply because we have essentially zero interest rates. Secondly, if you come to me and say stocks are terribly overvalued, I agree with you. And then you say, Mark, so why do you own shares? Why don't you sell out of everything and put all your money into cash? Then I say, okay. And then I ask you, well, what kind of cash should I hold? Then you say you can have bank deposits or treasuries and so forth. There's also risk in those instruments. With the banks, there is a risk that if they go bust, there'll be a bail-in, like in Cyprus, where large depositors have to pay, or lose 70 or 80% of their money. Or there is a risk in the currency and so forth. So if you really analyze the situation and you're ultra bearish, and I'm from a longer-term perspective very negative, in that situation you may be better off in equities, in companies that will survive Armageddon, than in cash and in sovereign bonds. But who knows? You don't know, because as you just said, the central banks are manipulating markets.
Yeah, they're manipulating everything. And once you manipulate interest rates, it sends reverberations out into all the other different markets.
Of course.
But you brought up a great point there. I think it's really dangerous to be all in cash or all in gold. There's a lot of people right now on Wall Street that have way too much exposure to stocks. Although I think now a lot of hedge funds, Mark, are starting to go net short. It's a lot of retail money that has come in lately into stocks, especially since the Dow hit 20,000 and then briefly it hit 21,000. Normally in the past when the retail money, the dumb money started to come in at the top, that normally signaled that we were overdue for a major correction.
Correct. And then you also have to analyze what people buy. Last year, one of the most traded and bought stock was Valiant. And as you know, Valiant is down 95% from its peak. So we also have to analyze what people buy. I suppose a lot of people, especially the millennials, they bought Snap, and Snap hasn't done anything since it started trading on the exchanges. It's actually down from the first trading day. So it's really a difficult situation. I'd say if you own shares, buy the shares that are out of favor, that are depressed, that are reasonable value. Probably the most inexpensive group of stocks are gold, silver, and platinum stocks. And then you have utilities that are not that expensive, and REITs have come down. And I would expect that if things deteriorate, that interest rates will go down once again. That would be my bet.
Now, Mark, I hear a lot of hedge fund managers talk about a U.S. dollar shortage globally. According to the Bank of International Settlements, there's about $10 trillion in outstanding U.S. dollar denominated loans. What's your take on this global U.S. dollar shortage? Is there actually a shortage?
No, there is no shortage, but liquidity can expand and tighten. And so after 2011, the rate of liquidity expansion has been slowing down, and late last year it turned down slightly, and now it's still down, but there isn't a shortage. If I want to borrow dollars, I can borrow any kind of dollars. It's not a problem. And don't forget, the U.S. is a reserve currency. The U.S., through its annual current account deficit, for as far as I remember, since the 60s, since the late 60s, there is a huge pool of dollars in the world. And this pool of dollars floats around. It can be invested in euros, or it can be invested in European assets, in Japanese yen, or Japanese assets. It can be invested in Asian stocks or Russian stocks or Latin American stocks, emerging markets, or in Europe and so forth. A lot of that money has flown into the US dollar, but there isn't a dollar shortage. The dollar is freely available.
Yeah, I completely agree with you, Mark. And a lot of people that are claiming this dollar shortage, a lot of them were irresponsible. They're, foreign politicians who took easy money when it was cheap, and they didn't care or think about how paying it back later when their currency became devalued against the dollar. They only wanted to, if they were a politician, they wanted to buy votes or to spend money to get to stay in office and get re-election.
Yes. I mean, the thing is, if a currency depreciates sharply against the US dollar, and that country has a large US dollar debt, its liabilities increase in local currency terms. Say if I have a foreign debt denominated in US dollar of 50% of GDP, and then there is a devaluation of my currency by, say, 50%, then that dollar debt as a percent of my economy increases, and it becomes more burdensome. But that doesn't mean that there is a dollar shortage. It's just more burdensome to pay.
Yeah, I completely agree. It's being mislabeled as a dollar shortage. I really don't know why people are labeling it that. I want to transition now to China. Do you expect more Chinese devaluations coming like Kyle Bass has predicted?
That I'm not sure. I think at this level, after the decline of the yuan against the US dollar, China is again quite competitive. They're not as competitive as they were a few years ago, because the costs of doing business in China, notably wage costs, have gone up substantially. But they are still highly productive, and they still have a huge trade surplus. So I don't expect actually the yuan to go down in the near future. What currencies will do in future, however, you and I and nobody knows, because as you said earlier, the central banks are manipulating markets, including interest rates and currencies, and also stocks by essentially buying shares.
Yeah, I agree. A lot of central banks have had their balance sheets expand a lot since the 2008 financial crisis. I suspect, Mark, that all currencies will take their turns on this devaluation carousel. I know in past interviews I've had with you, you've mentioned that basically these central bankers coordinate with each other, these devaluations, but I suspect that but I suspect that, no one's going to clearly win the devaluation race, and that gold and silver are going to be winners longer term.
Correct. And probably aside from gold and silver, assets that cannot be multiplied a lot, where the supply is very limited. So I would include, other commodities as well. But in general, my suspicion is that they will all print money when the global economy slows down, or if they have a financial problem in their own system. So there is not a competitive devaluation, but a coordinated devaluation, in the sense that it's a depreciation in the purchasing power of paper money. When you think what you could buy with $100 bill 20 years ago and what you can buy today, it's quite a big difference, that I can tell you.
Yeah, I completely agree. Yeah, people don't even notice it. They believe the stupid government inflation statistics, which are totally off base. Some of my food bills... Go ahead, Mark, sorry.
These statistics are criminal, not off base.
Yeah, I agree with that. They are criminal, but, the people in power, they have PhDs, so, the politicians won't throw them in jail because they give them a lot of math. So the politicians won't call them out on it, except for Ron Paul, who I think was probably the only politician who was calling them out on it. So you don't agree with Kyle Bass, then, that China's going to have to devalue the RMB another 20 or 30% to bail out their banks and their municipalities? You think China already has their foreign exchange reserves enough to do that already?
Kyle, I'm sure he has had some brilliant ideas and so forth, but he's been very bearish about Japanese bonds for a long time, and that was a disastrous trade. Everybody who shorted Japanese bonds over the last 20 years has basically lost money. And also the shorts on the yen haven't done well, and so forth. So I don't rely a lot on him. I agree with him that there is a credit bubble in China. But if we analyze the credit bubble, and the bank credit analyst has done a study on that, they argue, not everybody at the bank credit analyst, but one of their economists argues that the heavy borrowings of Japan and rapid credit growth has been due to a rapid increase in savings. And I can buy that argument to some extent. Not entirely, but to some extent. But all I want to say is, I live in Chiang Mai. 15 years ago, there were no Chinese tourists. 10 years ago, there were no Chinese tourists. Now, about 30% of people that come to Chiang Mai, and this is a tourist spot, are Chinese. And when I look at these visitors, it is not my impression that they come and pay with a credit card. My impression is that all these people pay cash, or have cash, or a prepaid card. You understand?
Yes.
So the system, some companies may be over-leveraged, and yes, there is a lot of abuse of credit in China. But equally, if you look at China, 20 years ago and today, they've rolled out a world-class infrastructure, and some money was borrowed. And so maybe here and there a company will fail, but at least they still have the infrastructure. What do they have in the U.S.? They have the Obamacare and transfer payments. And what have they done? Nothing. They went into wars and spent trillions of dollars in Afghanistan. Actually, they didn't spend it. They wasted it, and a lot of it was stolen. So they spent this money in Afghanistan, in Iraq, in Syria, in Libya, everywhere. What do they have from that? Most people around the world today, in contrast to the 50s and 60s, have a strong dislike for Americans.
That's very interesting. And yeah, the large...
And not for ordinary people. They just say, the government is so bad, and who votes for them, something is wrong.
Yeah, it seems obvious to a lot of people, but a lot of Americans.
Yeah, sure. I know Americans, they have renounced their citizenship.
Now, Mark, I want to ask you about capital controls in China. I spoke to a couple other contacts, and they said a lot of money has been leaving China. There's a high Bitcoin price. There's a lot of strong demand for physical gold in China. And I've heard the same thing out of India. So do you think that's a sign that the economy in China is not doing well?
The economy, in my view, had a meaningful slowdown last year. It has been stabilizing and reaccelerating this year, but it's a slightly different growth in the sense that it's less export dependent. It's more domestic consumption. And of course, the debt growth has continued. That I have to admit. And so I'm not saying that this is the most healthy growth, but look at the whole world. Everywhere in the world, debts have increased. In China, probably more so in the last 10 years than elsewhere as a percent of total debt and as a percent of the economy. So yes, I'm also concerned. But then I look at some Chinese companies, and if you go and visit them or hear their presentations, it's incredible how competitive they have become. They are world leaders in many sectors, and so something has been achieved, and it will be interesting to see how it will end. I suppose, like the U.S. in the 19th century and 20th century, they'll have once a massive recession, maybe they even have a civil war and so forth. So we had a civil war in the U.S. What happened? The country continued to grow thereafter.
That's a very interesting point. And yeah, I've heard that Chinese technology companies like Alibaba and Tencent and Sohu and Baidu are doing very, very well compared to a lot of other technology companies. They're taking market share from them.
Yes, but not only in technology. I was recently at a presentation and I talked about, I forgot the name. It's a company, they make window screens for cars. They're by now the largest in the world. They supply 70% of window screens of cars in China. They're going to move around the world into other countries. So these type of companies, they have an expertise, they have a niche somewhere, and they execute well.
Yeah, American companies used to be famous for that. Now there's been so much outsourcing and the quality of some American goods has fallen. I want to ask you now about the bond market.
There has been especially too much regulation in the U.S.
Yes, I agree. And corporations in the U.S. are taxed too heavily. So, they've been playing all these games, moving around their corporate headquarters on paper to Ireland or Switzerland. Hopefully I'm cautiously optimistic that Trump can fix some of these things.
Let's be optimistic.
Well, Mark, I want to ask you now about the bond market. Do you think the bond market is in a bear market now?
Well, that is the biggest question that is on investors' mind. I mean, either you're going to lose a lot of money by buying 10 years treasuries or 30 years treasuries, or you'll make some money. I don't think that yields will go down to 0.5% on the 10 years. But let's say we are now on the 10 years at 2.39%. I think we could go down to 2%, 1.75. The low was 1.43%. So I think we can still go down somewhat. Do we go down now, or do we go up in yields first, say to 3% on the 10 years? And then we'll have a recession, and then yields come down, who knows? Or is it possible that yields stay around this level in a trading range of, say, 1.75% to 2.6, 2.7% for the next couple of years? It's a possibility. That's what happened in Japan. And don't forget, the 10 years U.S. Treasury now yields 2.355% today. In the UK, the yield is 1.097. In France, 0.89. In Germany, 0.25. In Italy, it's 2.25. In Spain, 1.59. So tell me, what would you rather own, an Italian Spanish bond or a U.S. Treasury? Now, maybe the credit of Spain and Italy is better than the U.S., maybe, but I don't believe so. So in general, I think that the 10-year yield at 2.35% is, from an investment point of view, completely unattractive. For the next 10 years, if you hold it to maturity, you will earn precisely 2.35% annually. That's not an attractive return. But at the same time, I can say that maybe as a trade for the next 12 months, you'll be better off in treasuries than in equities.
Yeah, if there is a financial crisis similar to 2008 coming down the pipe, there will be a lot of capital flight to both U.S. dollars and treasuries for liquidity and safe haven purposes.
Correct.
I want to ask you...
you and I and your listeners, they don't know what will exactly happen. And in these conditions, I would say you have to have some kind of hedges. Now, some people will say, okay, I buy stocks. I'm 100% in stocks, and I hedge it with puts or with volatility indices and things like this. But these are expensive hedges. I think it's cheaper for you to have a diversified portfolio of equities, and then you have some treasuries, and you have precious metals, and some real estate. And then you diversify geographically. I mean, this year, this hoopla hoop about U.S. stocks being so strong. Okay, the S&P, as of today, is up 5.39%. Most European markets are up more than 6%. The Spanish market is up 13%. The Italian market, 6%. Then we come to Asia. Hong Kong is up 6%, and we have markets like the Shanghai index up 6%, Taiwan 13%, Korea 13%. This is all in dollar terms, I have to point out. And then you have India 18%, and you have Singapore 14%. So you understand, the U.S. market hasn't actually done very well, considering all the talk about how well the market has done in the U.S. Other markets have done much better. And I think that this year, some European stocks will perform much better simply because the euro is now very inexpensive compared to the U.S. dollar.
Those are great points. I'm not surprised that the U.S. mainstream financial media is over-embellishing how well U.S. stocks are doing, right? Because their sponsors are all mutual fund companies trying to get retail money to move into stocks still.
Yeah, absolutely.
Well, Marc, I wanna ask you my last question about this interview. Talk about President Trump. Do you think his spending programs are going to be very inflationary and stagflationary? And how do you think he's going to pay for his spending programs?
As he's got a friend say, I think, he came in as very hostile towards the Fed, and I think in the end he will be very grateful if the Fed prints money to support his spending programs. And by the way, the spending programs have to go through Congress and so forth. And the increases he actually proposes are very small. Say, when he talks about infrastructure, $1 trillion over 10 years, I have to laugh. We're talking about $100 billion a year. I don't have the latest figures, but by October of last year, October 2016, China had spent $1.6 trillion on infrastructure in the 10 months to October 2016. 1.6 trillion in 10 months. And Trump, he wants to spend $1 trillion over 10 years. It's a joke.
Hey, Marc, also to pay for some of this, besides the Fed printing money, the budget is so tight for Congress, the Congressional Budget Office is trying to tell Trump that he should consider a 15 to 20% VAT tax on all imports for U.S. That would probably hurt the economy a lot in the U.S. if that tax was implemented on consumption.
Yes, it would be very negative for the U.S., that I'm sure.
Yeah, I think when all is said and done about Trump, Mark, I think we're going to see a lot of misallocation of capital, and I think we're going to see a lot worse stagflation coming because even if he does the tax cuts, that could take years to implement, at least 2 years probably, and his other projects are going to take a couple years, and by that time, either the debt problem in the U.S. is going to be bad, or there's going to be some wage growth with politicians forcing wages higher.
Correct. But there's one more point I really want to make. The reforms Trump is proposing are not true reforms. He doesn't want to get rid of Obamacare entirely. He wants to replace it. And in my view, the replacements are probably even worse than Obamacare, which is a horrible program, a truly horrible program. Number two, tax reform. The only true tax reform in the U.S. would be to implement a flat tax on everybody without deductions. Today, as you know, the effective tax rate in the U.S. for corporations, I think is 35% or something like this. But the effective tax rate, what corporations actually pay, is less than 25%. Because so many corporations do not pay any tax at all.
Yeah, in the U.S. and Japan,
in the U.S., you need you need an army of good tax lawyers, auditors, and accountants to manipulate your tax rate down. That is more important than your sales. The manipulation of regulation and IRS laws.
Yeah, Mark, some corporations spend more money on lobbying than they do on research and development now. It's really sad.
Yes, that I'm sure. I also think some lobbyists earn more than most executives of smaller companies.
Yeah, I live like 20 minutes outside of Washington, D.C., and the Ferrari dealerships and Lamborghini dealerships around here are doing some of the best in the entire country.
Yeah, I can imagine. The hookers must be doing very well too.
They actually are. That's a really big thing here in D.C. that the lobbyists use for. There's other crimes involved, unfortunately.
And the underage children that are used for sex, they must be doing a booming business in Washington.
They actually are, and it's been known for a very long time. A lot of the government bureaucrats, like at the head of the Department of Justice and others, have been involved in this cover-up. The Julian Assange WikiLeaks stuff, that's what it was telling a lot of people about, was this global pedophile ring, and Washington, D.C. was one of the main areas.
Yeah, I'm convinced.
Okay, Mark.
Okay, take care.
Mo and I are trying to raise $1,000 per month for our Patreon account. We have over 2,600 viewers per YouTube video, so if we can get most of our loyal listeners or all of our loyal listeners to donate $1 per month or up to $5 per month, which would be amazing, that would cover most, if not all, of the money that we need. So we also accept one-time donations if you go to the wallstreetformainstreet.com website. We accept donations in cash via PayPal. Fiat, you can donate there. You can donate Bitcoin through our Bitcoin wallet there on the website, or you can donate gold and silver. We have a gold money account, and we also accept mail donations of physical gold and silver. Thank you guys for listening, and we appreciate any and all help. Please forward it to friends. Okay, bye.